think we have that. All right. I guess we are all set. Camera is rolling. Microphone is working. Welcome everyone to this workshop on 12 strategies to save taxes. Today is September 30th, 2025, Tuesday. In this workshop, I will be discussing some very powerful and effective way you can save on taxes, of course, legally. Fortune 500 companies use most of the strategies to lower their tax bill, pretty much down to zero. These strategies, when put in place correctly, can save thousands in taxes every year. So be ready for these golden nuggets that can change your business life forever. To begin, let me get some of the disclosures out of the way. Discussion in these presentations are general in nature. Tax planning requires a very poignant approach to an individual or an entity at a given point in time. Laws keep changing, so discussion in this presentation cannot be construed as tax advice for your situation. Please consult us for your specific needs so we can properly guide you. Our contact information will be displayed at the end, and if you are planning to send us an email, please write down today's workshop and the date in the subject line 093025 workshop and send the question and we'll promptly respond to your email. So if you have any questions right now, please hang on to it, and if the time permits, I will answer them at the end or send me the email with subject line 093025 workshop. Now let's get into the tax saving strategies. The first one is shifting income and expenses. Some deductions are under your control because you can decide whether to incur the expenditure now or later. Also, sometimes you are permitted to make tax selections on when to report income or when to claim write-offs. Here are some points that you can minimize your income and maximize your deductions. Or you can follow the reverse strategy. If you already have losses for the year and want to accelerate income to offset those losses and defer the deduction. So you can use this strategy to do both. Increase the income or decrease the income. For cash basis businesses, if you account for your expenses and income on a cash basis, you can influence when you receive income and claim deductions. For year-end items, for example, you can delay the billing for a few days for the services and merchandise so that the payment will be received in the following year. In deferring income for services or goods sold, do not delay billing so that the collection may be in jeopardy. Also, if you are an owner of a pass-through entity, factor in your tax bracket for this year and the bracket you expect to be in the next year. If you will be in a higher tax bracket next year because your income will be greater or because of tax law changes, you may not want to defer income. You may want to incur the income in the current year so that the income will be reported in the lower tax year. On the flip side, as a year-end tax planning strategy, you can accelerate the deduction by paying outstanding bills and stocking up on supplies. Again, determine whether accelerating deduction makes sense for you. However, in accelerating deductions, do not prepay expenses that relate to items extending beyond 1 year. For example, if you pay a 3-year subscription to a trade magazine, you can deduct only the portion of the subscription, that means 1/3, that relates to the current year. The balance is deductible in the future years as allocated. If you are an accrual method businesses, The board of directors of an accrual basis C corporation can authorize a charitable contribution and can make a note of it in the corporate minutes. A current deduction can be claimed even if the contribution is paid after the end of the year, as long as it is paid within 2.5 months after the close of the year. Similarly, accrual method businesses can accrue bonuses and other payments to the employees in the current year that are paid within 2.5 months of the close of the year. However, this rule does not extend to payments to S corporation or employees. Payments are deductible only when received by the owner employee. Second method you can reduce your tax is owner participation. This relates to Section 469. If you own a business, be sure that your level of participation is sufficient to allow you to deduct all your losses under the passive loss limitations rules and avoid the 3.8% tax on net investment income. Increase your level of participation and keep records of how and when you participated in the business. This strategy is very important, and the documentation has to be current and meticulous and very detail oriented. So if you want to employ this passive loss Section 469 strategy, please contact us. The third strategy is increase the basis in your pass-through entity to fully utilize the Section 704 and 1366 losses. If you are an owner of a pass-through entity, your share of losses are generally deductible only to the extent of your basis in the business. Explore ways in which to increase your basis so that the losses can be fully utilized. For example, if you are an S corporation shareholder, you can increase your basis by lending funds to your business, or alternatively, you can work with the corporation's lender, like bank, to restructure the debt, making you the primarily liable for the amount borrowed. So the loan will be in your name, and then the money will be loaned to the corporation. So that way you will be able to increase the basis and claim the deductions for the current year. The fourth way you can reduce your tax bill is by minimizing the FICA. Owner who work for the corporation may be able to extract the distribution on a FICA-free basis by arranging loans or rentals to the business and taking the payments in the form of interest or rents. Of course, these arrangements must be bona fide. However, as corporation shareholders who perform substantial services for the corporation should not erroneously characterize compensation as dividends and W-2 wages. W-2 wages are important for optimizing the QBI deduction, qualified business income deduction. So if you want to employ this strategy, please contact us and we'll plan those work papers and guide you properly. The fifth way you can reduce your tax bill is review your qualified plan selection. If you are a self-employed and use an IRA, SAP, or simple IRA, or other qualified plan to save for retirement, review your choice of plan annually to see if it optimizes your benefits while keeping the cost down. Factor in the tax credit for offering certain retirement plans and the conditions for qualifying for the credits. Similarly, corporations should review exiting plans to see whether terminations or other courses of actions are warranted as cost-saving measures. If you want to terminate one plan and begin another plan, be careful. Do not do so without consulting a pension expert. You must be sure that your old plan is in full compliance with the tax laws before it is terminated. The sixth way you can reduce your tax bill is by carrying medical coverage for yourself and your employees. Buy the kind of coverage you can afford as long as it meets the minimum essential coverage requirements. The business picks up the expense for your personal insurance protection. Even if you cannot receive this benefit on a tax-free basis, for example, You are a partner or an S corporation shareholder who must include the business paid insurance in your income. You may deduct 100% of the coverage on your individual tax return. So by avoiding that 7.5% itemized deduction threshold, you can get 100% deduction. You can reduce the cost of coverage by the business by buying a high deductible plan that allows employees to contribute to health savings account. So that will be additional deduction at your personal level. Alternatively, you can make deductible contributions to an HSA on behalf of your employees. So that will be shifting the deduction at the corporate level. If you are not subject to the employer mandate under Affordable Care Act, you can shift most of the cost of coverage to employees by adopting a premium-only cafeteria plan. Or you may be able to use a type of health reimbursement arrangement to help employees pay for their individually obtained coverage. All of this strategy will shift the deduction at the corporate level and bring the tax bill down. You may be able to use other reimbursement options, such as accepted benefit health reimbursement arrangement, to pay for certain costs not covered by the insurance. If you pay at least half of the premiums for your employees and qualify as a small employer, you can claim a credit for a percentage of your payments. The seventh way you can reduce your tax bill is instituting some other employee benefit plans. If you have a C corporation that is profitable and you are a shareholder and you are also an employee, you may be able to turn your non-deductible personal expenses into deductible business expenses. For example, you can have the corporation institute a group term life insurance plan for employees and obtain a tax-free coverage up to $50,000. Of course, in weighing the advantages and disadvantages of employee benefit plan, be sure to consider the cost of covering rank and file employees, since most benefit plans have strict non-discrimination rules. Also, take into account the fact that employer-paid educational assistance and adoption assistance plans cannot give more than 5% of benefits to shareholders owning more than 5% of the stock, usually making such plans undesirable for closely held corporations. The eighth way you can reduce your tax bill is by adopting expense reimbursement arrangements. If your corporation reimburses you for travel, work from home expenses, as for example, internet access fees and other expenses that you incur while you're working from home, then be sure that the arrangement is treated as an accountable plan. This will ensure that not only does the business save on employment taxes, but also that employees are not taxed on reimbursement. With an accountable plan, the business deducts the expenses and no income is reported to the employees. If your business is incorporated and you are an employee, you can benefit from this arrangement as well. The ninth way you can reduce your tax bill is abandoning some of the assets that are just sitting there idle and useless, instead of selling them for a minimum revenue or return. If you have property that simply is of no value to the business, you may want to abandon it rather than sell it for a nominal amount. This will allow the business to take in ordinary loss deduction, and it will avoid the Section 1231 gain and loss that requires a verification of the other 1231 property in the current year as well as last year. So by abandoning those useless property, you can claim the loss in the current year and avoid the 1231 loss limitations. The 10th way you can reduce your tax bill is by claiming the Section 165 deduction, which are the disaster losses in the prior year. If you suffer a disaster losses to business, property, or business in an area declared to be eligible for federal disaster assistance, consider claiming the deduction on an original or amended return for the year preceding the year of the loss, if this will give you needed cash flow or result in a greater benefit from the deduction. So you don't have to wait for the deduction to be claimed on the current year. and wait for the refund to come to the next year. You can claim the deduction in the prior year and get the cash now. The 11th way you can reduce your tax bill is review the business structure. Changes in the business climate, in business goals, tax laws, and state laws, they may warrant a change in the form of business organization. For example, your business may start as a sole proprietorship. Later, you may want to incorporate in order to take advantage of certain employee benefit plans. Review the options that will afford tax deduction and other benefits. Finally, the 12th way you can reduce your tax bill is by business equipment purchase. When the business can benefit from a large deduction, instead of depreciating the cost of equipment over the life of the property, consider electing the Section 179 deduction or using the bonus depreciation, or both. Alternatively, when the business cannot benefit from a current deduction because it does not have sufficient income to offset it, or you may be subject to the limit on excess non-corporate losses, consider other write-off options. Time business equipment purchases carefully in view of the mid-year convention. So with this, I'm going to conclude this workshop. When these strategies are implemented properly, they can bring your tax bill down substantially year after year. In the next workshop, I will show you how you can claim your non-deductible personal expenses as a business deduction at the corporate level. Thank you very much for today's meeting. It was a pleasure meeting you, and see you later. I will share the contact information so you can reach out to me by email if you have any questions.